Let's bring in Wedbush's David Chiaverini. He covers the regionals. David, I'm really glad to have you today because you're in the heart of this proverbial storm in terms of your coverage list is all over this space. How are you thinking about it today?
Yeah, it is surprising to see this level of a sell-off following the First Republic seizure yesterday, because this was front and center for the past month and a half. So you didn't have the same sort of shock and awe that occurred right after SVB went down, right after Signature Bank went down. People were prepared for First Republic to go down. So it is surprising that, this sort of reaction today, if anything, should have happened yesterday. So the delay is a concern. But what I'm thinking is that people are looking ahead, looking to the funding issue for banks, because rates are continuing to head higher. Deposit costs are continuing to head higher. And then credit quality. I think that what the market is telling us is that credit quality is going to be an issue, and commercial real estate is really what's getting the headlines here with the banks. So that's what's concerning us. We've been cautious on the banks for the past year or so. We continue to be cautious looking forward, and really curious to see how this plays out.
See, one of the things you just said, about deposit costs, it doesn't matter if deposits are leaving, right? And it's the kind of thing that Bill Ackman was tweeting about today. Fed's going to likely raise rates again tomorrow. You continue to push rates higher. You've got competition from money market funds like you haven't had in what feels like a generation at this point, and you're going to see more flight as a result.
Right. So you've got the Fed's balance sheet is coming down. It's not even the banks competing with one another. As you noted, they're competing with money market funds. So this funding pressure is really going to squeeze net interest margin. So you've got revenue pressure, you've got the cost pressure on the deposit side, and then when the credit quality costs end up going up, you're going to be left with far less earnings than what people were expecting earlier this year and certainly late last year. So multiples are coming down, and I think investors are beginning to shift towards tangible book value as kind of a baseline to support valuations.
Can you feel confident putting a buy rating on any of the stocks in your coverage list as we have this conversation today? I'm talking about PacWest, and I don't have your ratings in front of me. I just have your coverage list. So forgive me for that. PacWest, Zions, Citizens, Western Alliance. I mean, some of these are in the heart of this today. Do you have a buy rating on any of those? And if you do, how?
Yeah, so the only one out of those five you mentioned that we have a outperform rating on is Western Alliance. And that one, we do kind of put it in the category of higher risk, higher return. We just upgraded it right after they reported earnings when it was trading at $32 a share. And they really, what surprised me and was a good surprise is that of the $6 billion of deposits that left in the first quarter, they got $2 billion of it back quarter to date through April. So we're seeing some stability there. We're expecting $8 of earnings per share from them. So it's trading at, call it, 4 times earnings, even less than that. But we do put it in that higher risk, higher return category. And the other, reason for having some outcomes now.
Like PacWest, for example. Forgive me for interrupting you. What do you have on that?
Sure. Yeah, PacWest, we've got a neutral rating on that one. And they do screen poorly from a when you look at tangible book value on a fair value basis, they screen poorly in that regard. They've improved their insured deposit rate. They were down and screening poorly at 45%. They've increased that to about 73%. So that should add some stability to them. But I think what investors are focusing on for them is also capital. Capital has been an issue for PacWest. They're trying to increase their CET1 ratio. They attempted to do a capital raise in the immediate aftermath of SVB going down. They pulled that off the table. They're now looking to sell their lender finance business, $2.7 billion portfolio, to lower the size of their balance sheet to indirectly improve their capital ratio. So PacWest does have some wood to chop, and they do screen poorly on a number of metrics, and I think that's the reason why it's coming under such pressure.
Yeah, it's getting chopped, all right. And today it's getting chopped by another 25%. David, I appreciate your time very much.